Now the floor is yours, Dr. Lee. So ladies and gentlemen, please welcome him with a big round of applause.
Thank you. Good morning. I hope you had a very nice sleep despite the jet lag. This morning we are going to discuss monetary policy under the new normal or the new, I don't know what you want to call it, mediocre. I think this is a topic that some of you have already touched upon yesterday. For me, probably the best word to capture a monetary policy framework under the current environment is uncertainty. And here, uncertainty, I don't actually mean the geopolitical uncertainty, but rather three aspects that we take very valuable. The first one is actually the uncertainty surrounding estimation of potential output. Because essentially, depending on what model you actually choose or what assumptions you take, you pre-select your answer to some respect. And thus, the output gap is also up to some uncertainty. The second uncertainty that I refer to is measurement issue relating to unemployment. The supply of labor as well as the mode of employment have evolved fairly rapidly over the last decade or so, rendering the clear definition of unemployment somewhat ambiguous. And the third uncertainty relates to the factors affecting inflation. Some of the key factors that affect inflation do not require visas to cross borders. And thus you're not quite sure to what extent you're actually controlling inflation or not. So if you have listened carefully to what I just said, you will have realized that I have essentially thrown out of the window the basic monetary policy framework that we use to make policy decisions. But this actually had also some positive outcome, and that is namely, it has forced central bankers as well as academics to conduct more rigorous assessments and analysis and come up with more innovative ways of responding to the challenges facing us. So I regard this morning's session as an adding value to this ongoing effort in addressing the challenges that lies ahead of us. So in this regard, I'm very happy and pleased to introduce our speakers and discussants. And since the number of speakers and discussants are somewhat smaller than in the previous session, I hope this will also give us opportunity to have more time for Q&A. And I'm not going to spend a lot of time introducing our speakers. The first one is Joseph Gagnon, Senior Fellow, Peterson, with work experience at the Fed and US Treasury. And the discussant will be Deputy Governor Jeon Seung-Cheol, responsible for the research, statistics, and the BOK Academy. The second speaker will be Douglas Laxton, IMF, expert in macro models, including for inflation targeting frameworks. And the discussant will be Shigenori Shiratsuka, DG, Bank of Japan, heading the Monetary Economic Studies Division, at the BOJ. So without any further ado, let me now turn to the first speaker.
Thank you. This paper is written with Philip Turner, who some of you may know, recently stepped down as the Deputy Director of Monetary and Economics Department at the BIS. And in case I get cut off by the bell, I'll give the key points up front. As other people said yesterday, most advanced economies and some Asian emerging markets have experiencing slower trend growth rates and lower equilibrium real interest rates. Our view is that in response to this change, a number of central banks, not all, but some, have been slow to adapt, and they've left interest rates too high, too tight, and this has put unwanted downward pressure on inflation. We argue that ultra-low inflation below 2 or even 2 perhaps, but certainly below 2 is harmful to the economy. We think that central banks really have a duty to achieve their inflation targets, which should not be less than 2, and that monetary policy has to make its primary focus on inflation and growth. And that may be the best thing it can do for financial stability. Macroprudential policy needs to focus on financial stability, and we have tools to do that. Finally, trying to reverse the slow growth through export-led growth by weak currencies and trade surpluses would only heighten international tensions. I'm not going to talk about this very much. A number of Asian economies seem to be slowing down in their trend per capita growth rates, but a few are picking up. It's not a universal story. We'll focus a bit, though, on the slowdown story. In most Asian economies, especially the slowing ones, but even the non-slowing ones, inflation is currently, this is through last year, 2016, currently near very low historic levels. We think that it's important that central banks should achieve their inflation objectives and keep inflation from being both too low or too high. And as Milton Friedman told us, inflation is always and everywhere a monetary phenomenon, so monetary policy must be the main tool used to achieve price stability, and it obviously does have effects on other variables, but we can't lose sight of its principal objective. So why do we worry about inflation, very low inflation being costly? Well, there's abundant evidence out there in the literature of downward nominal wage and price rigidity. Firms and workers strongly resist taking nominal pay cuts. When the overall distribution of inflation across individuals moves to 0, that means that for every person getting a wage or price increase, another person has to get a wage or price cut. They resist that strongly. In order to force them to take those wage and price cuts, you've got to run the economy very weak with a large output gap. This is wasteful. We think we shouldn't be running monetary policy this way. And that's the key message why ultra-low inflation is costly. And it's demonstrated very clearly in the case of Japan. If you look in the upper right corner here, since the mid-90s, core inflation in Japan's been pretty much bang on 0. And so Japan really has been hurt by these downward rigidities. And what's happened is that the unemployment rate soared and stayed at record levels throughout this period because that's what was needed to force people to keep taking pay cuts and price cuts. Even the Bank of Japan shows that the average output gap fell significantly once they moved into deflation. It has averaged a -1% throughout, according to the Bank of Japan's own data. We actually argue that it might be even a bit bigger, more like -2% on average over this period, if you think about Okun's law on unemployment. A 2% loss of potential output for 20 years is an enormous loss of economic potential. Now, I stress that we heard a lot yesterday about the declining trend growth rate and structural reforms to raise the trend growth rate in Japan. I totally agree with that. That's a bigger picture, that's a bigger point, it's very important. But even given whatever Japan's trend growth rate is for whatever reason, the government of Japan has not achieved it sustainably and steadily over this period. That's a secondary point, but still a big point. And so we think that it's best not to get into ultra-low inflation. The economy will work better if you have moderate positive inflation. Now, as many people said, one more point. Although I agreed with just about everything people said about Japan yesterday, one disagreement I had was Professor Kawai, who argued that the labor market was very tight in Japan and it was a puzzle as to why there's no inflation in Japan. I would argue the labor market is not particularly tight in Japan. Unemployment is still above its historical average. However, even if you think the Nairo has risen, fine. The Bank of Japan says we're only about at potential now. So again, at best, we're at potential. Why would you expect a rise in inflation if you're only at potential? You need to go well above potential to get inflationary pressures. We haven't seen that yet. So to me, there's no puzzle. Japan wouldn't be expected to have inflation because it hasn't had a positive output gap. Many people said there's a decline in the equilibrium real interest rate. There's certainly a lot of studies showing that for the advanced economies. And this has to do with trend growth rates and high saving propensities. It seems to be spreading to Asian economies. It's not clear whether it's a spillover from advanced economies or whether some of the emerging markets are facing the same underlying shocks to demographics and productivity. I tend to think that the latter has a lot of merit. Olivier Jeon talked about this. But what is clear is that the correlation of bond yields around the world has increased. And so if there are spillovers, they are stronger now than they used to be, and they would tend to push down the equilibrium real rate. So this is the short rate, and it's declined in many Asian economies. I won't spend time on that. Local currency bond yields, where they exist, have generally been falling in Asia, this is the correlation of bond yields. The US yields and some Asian yields have become more and more correlated over time. And that could be because of common shocks, or it could be because of spillovers. The vertical line here is the taper tantrum, which is clearly a US-centered shock, but it did spill over into Asia. So we have more correlation to bond yields. This is an important risk we need to think about, and I'll come back to that. So why should we worry about declining real rates and low inflation? Well, if the real equilibrium interest rate is low and the inflation rate is low, then that doubly means the nominal interest rate is going to be very low historically, and it's going to come close to the zero bound, below which you can't really go, or not very much. And this raises some risk for policy in the future. For example, in the case of Korea, the policy rate's just a bit over 1%. That's the solid line here. If Korea faced a shock, a recessionary shock, it wouldn't have much room to lower the policy rate. In the global financial crisis, Korea lowered the rate over 3 percentage points. And that's not an unusual move. In the typical US recession, the Fed lowers its policy rate more than 300 basis points. And in the Great Recession, it did much more than that, and plus QE, equivalent to 800 or 900 basis point cut for a big shock. Even for a small recession, you might want to lower 200 or 300 basis points. Korea no longer has that capacity to do that. Now this, I don't want to get you too worried. I mean, we do have unconventional policy possible. We'll talk about that in a minute. But it would be nice if conventional policy had more room to maneuver, because we're more familiar with how that works. A similar development's happening in Thailand. Inflation's quite a bit below target. This is core inflation in Thailand. And the policy rate is now well below 2. That means that in a normal, even a small recession, the Bank of Thailand would run out of policy room. And so it'd be better to raise the inflation rate to let the nominal rate go higher for the same real rate, and give the central bank more room to maneuver before you have to deal with unconventional policy. Okay, and let's see. So there's been several criticisms that we rebut in the paper, one of which is maybe central banks should save their ammunition if there's not much room to maneuver. We argue the opposite. In fact, if you're undershooting your inflation target, you need to get back all the sooner if you're near the zero bound. There's a number of research papers that discuss that. In fact, as I'll discuss in a minute, you do have some tools to do that, including unconventional policy. But another criticism is, what about the Phillips curve? Can we even raise inflation? The Phillips curve's been very flat lately. Does that mean that we don't have any power over inflation? Well, I have some regressions in the paper that challenge this. I'm going to go through them in a graphical form, which may be easier. And this is using US data, but I believe it would be true in other countries, including in Asia. What I'm showing here on the vertical axis is a measure of inflation surprise. So it's how US inflation moved relative to some lagged measure of expectations, what it was expected to be. The top two panels use a survey of professional forecasters. The bottom panels just use the actual lagged inflation, current inflation minus lagged inflation, but they're both measures of a surprise move in inflation. That's the vertical axis. The horizontal axis is the output gap. In this slide, I use the unemployment rate, and I take the Congressional Budget Office estimate of the natural rate of employment, I subtract the actual rate of unemployment. So that a positive number says that unemployment is below the NAIRU, so you have a positive output gap, and a negative number is slack in the economy. And I split the sample into periods in which inflation is below 3% and inflation is above 3%. And what you see is that when inflation is above 3%, we have a normal Phillips curve. As output expands above capacity, inflation goes up higher than was expected. And if anything, there may be some curvature in this, as Doug Laxton has done some work in this area, that it's even stronger for higher positive numbers. That seems to be there, but it's not very strong. But what's clear is that in the high inflation regime, there's a strong positive Phillips curve slope. But in the low inflation regime, it's clear that we've seen a very flat Phillips curve, and this is what people are talking about. In particular, big output gaps, the left tail, aren't lowering inflation because of the downward nominal wage and price rigidity I mentioned. And so this is true, this is where we've been. But note, we haven't seen any positive output gaps for a long time. The vertical lines here surround the zero output gap estimate, and basically the economy hasn't been overheating for a very long time. So we have every reason to expect that if we did overheat the economy, we would get upward pressure on inflation because there wouldn't be any resistance from downward wage and price rigidity, and we'd get back to something more like on the right panel. Obviously that's to be shown, but we have an argument for why we've seen a flat Phillips curve, but we believe that it wouldn't remain flat if we actually had a positive output gap. And this chart just shows the same thing using a different measure. It's the Federal Reserve's capacity utilization measure with vertical lines centered around the mean value. And again, what you see is that in recent years, we just haven't had many positive observations to raise inflation, and we've had a flat Phillips curve because of downward price rigidity. But there's no reason to believe that we wouldn't get pressure on inflation if we tried to push the economy run it hot. Now, the second criticism we get is, well, even if we could, even if the Phillips curve still lives, we're near the zero bound and we can't get more inflationary pressure. Well, you can ease monetary policy using unconventional policy. The advanced economies have done a lot of that recently, and many studies exist. 95+% of the studies all agree that unconventional policy did have a stimulative effect, and there's no reason it couldn't work in Asia. What this chart shows is basically the first column is the size of the central bank balance sheet in Asia, and then the next three columns are the types of domestic assets they could purchase if they wanted to deliver unconventional monetary easing. And as you can see, although some assets are scarce in some countries, there's always something that they could do. The second column is government bonds, which is what the conventional, sort of conventional, unconventional asset that has been used. The final column is the equity market, which is something the Bank of Japan's tried a little bit and Hong Kong did a while ago, but hasn't been used much. I think it's actually a very promising area for stimulus if you needed it. And then the third column is the size of the banking system. One little discussed element of unconventional policy is subsidized lending to the banks, which the Bank of England and the Bank of Japan have done to some good effect. And that sort of is, the scope for doing that is related to the size of the banking system, which is sort of the third column. But the bottom line is there's certainly some options for all of these central banks if they wanted to do unconventional policy. So then the third criticism we get, and final criticism I'll discuss, is are low rates going to get us into a world of financial instability? Well, we note, first of all, that the evidence that people take on too much risk in a low rate environment isn't very strong. And there's actually, it goes both ways. If you have rates that are too high for the economy, you tend to cause more bankruptcies and failures, which is actually not good for the economy either. So it's not clear what the net direction of low rates is. But what is clear is that the greatest monetary mistakes in history have been associated with letting too much inflation or deflation. And of course, this doesn't mean that you have to look only at inflation. You should look at the overall economy, and if there's overheating, you might want to tighten policy even before you see the inflation. That's fine. But you shouldn't take your eye ultimately off the inflationary ball. Now, if you still worry about low rates and how that causes risk to financial stability, there's sort of a paradox here. Because it may actually be that in a recession, if you need low rates for recovery, you'll actually get back to high rates sooner if you lower rates more aggressively now. And that is my reading of the story of the past 10 years, where the Bank of England and the Fed were more aggressive and earlier, cutting rates deeper and doing unconventional policy sooner, and are now in a position of being able to raise rates and go back to normal sooner than other central banks that were more reluctant to do that and have paradoxically ended up in a low-rate environment longer, even though they didn't want it. So I think you have to be careful that if you're too timid in going to low rates because you don't like low rates, you'll actually end up with low rates longer. Should central banks lean against the wind for macroprudential reasons? Obviously, if you do buy that monetary policy affects financial stability, should there be some scope for adjusting policy in that direction? Well, maybe, but real-world examples don't really seem that kind to that view. Before the Great Recession, the UK went in that direction. They raised rates because they were worried about high asset prices. Didn't work out that well for them. The Bank of Canada chose not to do that. They ended up having a better experience. The reason was they had a better macroprudential environment, which seems to be the more important channel. The key, though, is that in a low-rate world, there is always a risk that if rates bounce back up, there'll be losses somewhere, and the key is to make sure that firms and households are able to withstand that possible shock. And the way to do that is to have capital requirements and leverage regulations and stress tests to make sure that agents haven't taken on too much risky debt and can deal with a change in the interest rate environment that might come. Finally, it's not always the case that monetary policy has to move in the same direction as macroprudential policy. I mean, they often might want to, but we shouldn't think that it has to be the case. So let me turn to the final brief topic very briefly, which is exchange rate policies. Is seeking trade surplus and export-led growth a way out for Asian economies? Well, except for India and Indonesia, all Asian emerging markets already have trade surpluses, and India and Indonesia have very small deficits. So there doesn't seem to be a general problem here of insufficient external demand. I would argue that trying to get more growth that way is going to raise international tensions. Asian economies have relatively high historical foreign exchange reserves, and if you look more broadly at their net positions, including net foreign currency debt, which is shown here as net official assets, things also look good in historical context. So it doesn't seem to be a strong case to build up reserves for a precautionary motive either. But I would argue that at this point, that would not be good for international tensions. So finally, to conclude, monetary policy must focus on inflation and growth. Only monetary policy ultimately can deliver on stable prices. It's essential for credibility that central banks achieve their targets, and they should be at least 2%. We don't take a stand on how much higher they could be, but 2 is a minimum. Central banks have the tools to achieve this. Probably the best thing central banks can do for financial stability is to deliver macro stability. And as Adam Posen said yesterday, that's not a sufficient condition for financial stability, but it may be the best we can hope for monetary policy, and we'll need to bring other tools to bear. Sometimes these other tools will go with monetary policy, sometimes they won't. And finally, trying to weaken one's currencies to get trade surpluses is not going to be needed, justifiable in terms of having trade deficits right now, which Asian countries don't have, but also will raise trade tensions. Thank you.
Good morning, everyone. It is my great pleasure and honor for me to have a chance to contribute to this conference. Gagnon and Turner's paper contains many interesting and inspiring ideas, suggestions, and analyses. I enjoyed reading the paper a lot. Let me first summarize Gagnon and Turner's paper briefly, although he already summarized his paper well, because it is related to my comments. The summary will be selective rather than comprehensive, following my interest. Then I will present several comments, mostly related with Korea's current economic situations. Gagnon and Turner characterized recent macroeconomic development in major Asian economies, including Korea, Thailand, and Taiwan, which might be summarized as follows. First, there is a convergence in terms of per capita GDP in Asian economies. Richer economies tend to grow more slowly. About half of the larger Asian economies are slowing down. Second, inflation rate also lowered down below its historic average. Economies with inflation below 1% in 2016 tend to be economies in which GDP growth slowed the most over time. Third, real short-term and long-term interest rates have declined in line with those of advanced economies. Next, the paper emphasized the cost of ultra-low inflation. Under ultra-low inflation, relative price become more difficult to change. The fear of deflation spiral can lead households to cut spending, adding further downward pressure to an already weak economy. Once ultra-low inflation gets stuck into the economy, raising inflation back to 2% is much harder than in the case of Japan. Low inflation rate reduces the scope for a counter-cyclical monetary policy with a low equilibrium real interest rate. And next, the paper recommends further expansionary monetary policy for Asian economies suffering from slow growth and low inflation, not to be trapped in costly ultra-low inflation. To back up the argument that monetary policy is still a viable option to cure low inflation, the paper shows empirical results obtained with the US data. The slope of the Phillips curve is still positive, particularly steeper when inflation is higher, say beyond 3%. The paper goes on to argue that Asian economies also have at least some scope for unconventional monetary policy, like negative policy rate, quantitative easing, and balance sheet policies, when the conventional policy is near zero. The policy rate is near zero. It says the central banks has to make greater use of balance sheet policies to offset the impacts from another taper tantrum. Next, Gagnon and Turner's paper provides an answer to the central bank's long-lasting dilemma on the role of monetary policy for financial stability. The paper insists that risks to the financial stability should not constrain monetary policy. It points out that even though a prolonged period of low interest rate could create risks for financial stability, keeping policy interest rate higher than warranted by macroeconomic conditions would not guarantee financial stability, since subpar growth and high unemployment also create financial stability risks. Keeping interest rate up in the face of prolonged periods of low inflation would also run counter to the inflation targeting mandates of central banks, it says. Thus, monetary policy should focus on price and output gaps. And, macroprudential policy should need to be adapted to curb financial risks associated with a long period of very low interest rate. Okay, this was a summary of Gagnon and Turner's paper. Now my comments comes, and they are mostly from practical viewpoint and related with current Korean economic situations. First, I review recent output and inflation trends in Korea to see whether Korea needs further expansionary monetary policy, possibly with unconventional policy tools to avoid ultra-low inflation trend. Let's start with reviewing recent macroeconomic conditions in Korea. Korean economy has been showing mild recovery from early this year, with a strong export backed with the global economic upturn. Although there is several downside risks to growth, like escalating geopolitical tension with North Korea, we expect the mild recovery trend will continue at least the next few years. The BOK STEP's recent forecasts show that the growth rates are around 82% this year and the next year, which are very close to our estimation of the potential growth rate. As you can see in the left graph, the negative outgap of the Korean economy is not large currently and is expected to narrow down gradually in the future. The headline inflation rate had stayed around and below 1% for several years, but it started to increase late last year and reaches the inflation target of 2% recently. The core inflation rate has remained about 2% during this period, and is forecasted to remain roughly similar level next year. Let's look at the inflation trends a little further to gauge the possibility that it would be stuck at an ultra-low level. As we saw already, the CPI inflation had been persistently low in 2015 and 2016, and the decomposition of the inflation rate reveals that it was mostly owing to the sustained low oil prices during this period. As we can see in the graph, CPI inflation rate, excluding oil prices components, has been around 2% since 2015. Next, let me show you some measures of inflation expectations in Korea. The inflation expectations from surveys on the general public, which is the red line, have stayed in the mid 2% level over the period of low inflation rate. Inflation expectations from surveys on the economic professionals had declined for a while on the low CPI inflation rate, but they recently turned up along with the rising actual inflation rate. With these observations, I'm not sure we can say the Korean economy is still in a stage where deflationary trap is possible and further expansionary monetary policy is necessary. Next, let me talk about the slope of the Phillips curve. Although the Phillips curve estimation depends heavily on the model specification, sample period, and the data, Gagnon and Turner's paper presents very interesting features of the Phillips curve. That is, the slope becomes higher when inflation rate exceeds a certain level. It gives very important implications for the monetary policy setting. On the other hand, I think we should be mindful for the possibility of the slope might be flatter than the level estimated with the past data, even in the case of a high inflation, because of several factors. Expanded trade and intensified global value chain in manufacturing may play as a factor weakening the relationship between employment and inflation rate. Structural changes in labor market, such as the increasing portion of partial or part-time employment, may lower the degree of pass-through from labor market conditions to wage growth. For reference, I show the result of the BOK STEP's estimation of the Phillips curve with Korean data. You can see the slope of the Phillips curve is not minimally positive and quite stable over the sample period. Okay. Next, let's take a look at the Bank of Korea's current monetary policy stance. Since global financial crisis, there were two periods in which the BOK lowered its policy rate in a series. In June 2016, the policy rate was lowered to 1.25%, which is the lowest level in history. The BOK has been maintaining this level of the policy rate since then. Here, I examine the BOK's current monetary policy stance with multiple standards. First, the left graph shows the policy rate has been lower than two measures of Taylor rule rates. First one followed Taylor 1999, and the second one followed Clarida, Garley, and Jettler 2000. Although I do not show The estimation result of the neutral interest rate here, the current policy rate is also lower than the BOK steps estimated level of neutral interest rate. Right-hand side graph shows that the financial conditions index, the FCI, is extracted from about 50 financial variables, and its positive level, as shown in the graph, indicates that domestic financial markets are, overall, in loose condition. Next, I would like to mention that macroprudential policies also have limits in their effectiveness, and least in practice. Economic agents always have incentives to find loopholes in existing regulations. On the low inflation rate environment, those incentives become stronger. Thus, financial regulation policy may not warrant financial stability on the prolonged low interest rate in the real world. In fact, Korea's household debts have been rapidly expanding even after the authorities implemented harder regulatory policies such as lower loan-to-value guidelines. When monetary policy and macroprudential regulation policy are assigned to different institutional agents like Korea, practical difficulties exist in coordinating monetary and macroprudential policies. In this case, central banks inevitably has to consider possible risks that prolonged low interest rate may create. Finally, it is indeed important for small, open, and emerging ASEAN economies to prepare enough policy tools to offset any possible impacts of taper tantrum. As the paper mentions, the 2013 taper tantrum demonstrated how vulnerable emerging economies' financial markets were to the Fed's policy rate change. However, we also observed that financial markets of those economies showed stability in the events of Fed's recent rate hikes. It might be a result that came from the Fed's careful communication. Anyway, concerns about taper tantrum seems to have slightly abated recently. I would like to add that the BOK has prepared and regularly reviews policy tools to deal with the possible financial instability, such as taper tantrum. I'll finish here. Thank you.
Thank you. Good morning. After reading Joe's paper, I tried to find something to actually disagree with him about. And it turns out that he uses the term flexible inflation targeting, okay? And it turns out flexible inflation targeting, really when we flesh it out, is really inflation forecast targeting. So all I want to do is to rearrange the letters. Rather than FIT, I want to call it IFT, but virtually everything he said, I agree with. So first thing, obviously, these are the views of the authors and not necessarily the views of the IMF. Okay, so what is inflation forecast targeting? So I've actually helped many central banks actually create inflation forecast targeting systems. So I'm going to talk a little bit about what it is. It's very much along the lines of what Joe was saying, but he was focusing more on specific examples. So what is inflation forecast targeting? Well, when you have an inflation forecast targeting central bank, the central bank's inflation forecast becomes this ideal intermediate target that is used to communicate how the central bank is managing the short-run output inflation trade-off. And this can be an explicit or an implicit dual mandate central bank. So in other words, it can be written in the bank law that they have to care about output and inflation, or they can just do it because it's a sensible thing to do, and trying not to ignore the output part of it can be destabilizing. It's also ideal in the sense that this inflation forecast is based on all available information and views about how the economy works. And I really want to emphasize this, that as practiced in the most experienced IFT central banks, the emphasis is really on uncertainty. For example, uncertainty about the output gap or uncertainty about the coefficient in the Phillips curve. It's really all about what Olivier Blanchard said avoiding dark corners, or what's commonly referred in central bank lingo as the prudent or risk management approach to policy formulation. It starts off with an analytical framework. In fact, the first central bank in the world that did inflation forecast targeting had flexible exchange rates for 20 years before it, and we actually designed an analytical framework specifically to do inflation forecast targeting. The country was Canada, and I was the guy that actually developed the framework at the Bank of Canada. Having developed the framework, I then moved to the IMF and actually then advised a bunch of central banks about how to actually do this. Most of the other central banks that moved to inflation targeting were really thrown into the inflation targeting world because they had to abandon pegs. In other words, they couldn't actually maintain their existing regime, or monetary aggregates abandoned them. So it's not like they abandoned monetary aggregates, but the money demand functions were so unstable. So these inflation forecast targeting central banks have an analytical framework like this. They think in terms of objectives and instruments. So the objectives are output and inflation. The policy instrument in normal times is not just the policy rate today, it's the entire expected path of the policy rate, because that's what influences longer-term interest rates and asset prices like the exchange rate. Now, why do you want to be aggressive, as Joe was suggesting? Well, because you want financial markets to anticipate that if there's a contractionary shock that's going to reduce inflation below the target, that you're going to be cutting interest rates in the future, and as a result, long-term interest rates are going to fall, the exchange rate's going to depreciate, and those things are going to act as important shock absorbers in the system. Now, of course, when you run into the effective lower bound on interest rates, this can be a very destabilizing process, because if the same shocks come along that reduce demand or reduce inflation, they can actually drive the real interest rate up and appreciate the currency. So you can have asset prices responding in a very, very destabilizing way. So now, these central banks that do this do not take all of these transmission channels as given. They're constantly studying what the uncertainty in these linkages are and preparing strategies for dealing with those things. So another aspect of doing this, when it's successful, and this is looking at some data on inflation expectations from very seasoned inflation forecast targeting central banks. So they are Canada, which was the very first country to do it, the Czech Republic and New Zealand, which were the next two countries to adopt this regime, and then Sweden and obviously the United States. So if we look at this is looking at data from Consensus Economics, their long-term survey that they do 4 times a year. And obviously, if you look at inflation since 2015 and 2017, which has been below target, people have expected, forecasters have expected that inflation was going to remain below target this year. Now, what we would like in a successful IFT regime is that people would think that the forecast for inflation 3 years into the future, which is a horizon that monetary policy should be able to work on, should be either at the target or a bit above the target. So inflation's below the target today. We want to provide enough stimulus so that people think that we're going to get back to the target in a few years, or that we're going to actually provide a little bit more stimulus so that it overshoots the target. And why is that good? It's good because then inflation on average is actually closer to the target. And so then people have much more confidence that inflation is going to be 2%. And that starts to get reflected in things like wage agreements and pricing decisions and so on. Whereas if we look at Japan, obviously, not only is inflation expected to be below the target this year, but it's also expected to be below the target 3 years into the future. Very similar situation for the euro area. So inflation's below the target today, and it's expected to remain below the target 3 years into the future. This is not a good thing, okay? We want to have policies that are sufficiently stimulative that, you know, as Joe was saying, that maybe make the output gap go positive so that you can get people to believe that inflation is going to rise. So this is looking at monetary policy transparency. Turns out inflation forecasts targeting central banks have the highest levels of transparency according to measures by Dinser and Eichengreen. So this is what DE means. So Canada, for example, again, which had this framework in place when it first adopted inflation targeting, they would basically publish a forecast of output, inflation, and so on, but they never published the forecast for the policy rate. Instead, what they did is they simply used words to describe what were the policy assumptions that were behind their output and inflation forecast. So actually, we recommended in our last article in a paper with Maury and so on, that they actually start moving right to the frontiers, which are some of the other central banks have done. Now, amusingly, after Canada developed the framework, remember, New Zealand did not have a framework when they first started doing this. And so the very first stop after moving to the IMF was to the Reserve Bank of New Zealand to try to help them develop a framework for doing this inflation forecast targeting. What's amusing is that it took them until about 1997, so they adopted in 1990. It took them to 1997 to develop this thing called the Forecasting and Policy Analysis System so that they could think in terms of instruments and objectives. They published it. They told financial markets this was the framework that we were going to be using for setting interest rates in the future. And as a result of that, they immediately published the path of the policy rate. So they moved to the highest levels of monetary policy transparency. Again, Asian crisis hits, a lot of countries get thrown off of pegged exchange rates. The Czech Republic was one of them. And of course, they didn't have any system, so they had the benefit of starting from ground zero. Turns out there's a big benefit from starting from ground zero because you can look around the world and ask, how is it done in the best central banks in the world? And you can adopt, first best practices. So the Czechs, by 2002, they adopted inflation targeting in 1998. And by 2002, we had developed the forecasting and policy analysis system in the Czech Republic. They decided initially not to publish the path of the policy rate. So they wanted the board, the Monetary Policy Committee, to get used to using this framework for thinking about setting interest rates before they actually published the path of the policy rate. But by 2008, the board decided that since we're using this to think about monetary policy, this analytical framework, why don't we publish the path of the policy rate? This was before Lehman's, which was quite an interesting call. Lots of central banks, remember July 2008, oil prices were $150. Central banks were talking about raising interest rates. In fact, the ECB actually did raise rates. The Czech National Bank puts out a forecast that says, look, a lot of these factors driving inflation are temporary, and we actually think that the global economy is going to slow down. The Czech economy, because it's very, very open, is also going to slow down. So we need to think about cutting interest rates in the future. So they're thinking about monetary policy in a very forward-looking way, and they actually do cut interest rates before Lehman's. So anyway, it turns out that when you publish this path of the policy rate, it actually makes central bank communications much easier, okay? Because if you don't publish it and you try to think of words to describe what monetary policy is going to be doing in the future, those words can somehow, be misinterpreted. Whereas if you have this forecast with confidence bands around it, it's much easier to find the words and there's less of a chance that it will be misinterpreted. So the rest of my presentation is going to be based on applications of these ideas to some Asian countries. In particular, we're going to talk about India a little bit, Japan, and I think I'm going to focus mostly on Australia. So one way to think about this is about avoiding low and high inflation traps. So we all know that escaping high inflation traps is costly. You have to generate economic slack, not only to reduce inflation, but you have to actually generate some economic slack to anchor long-term inflation expectations after you've brought inflation down. Escaping from low inflation traps can actually be even more difficult, and it requires doing whatever it takes using a wide range of instruments. So this could mean if you're at the effective lower bound, you might have to use even fiscal policy or even more exotic policies like incomes policies. Obviously, escaping from a deflation trap can be even more difficult. What we should be thinking about, as Joe prescribes, is avoiding a low inflation trap. So we cut interest rates aggressively so that we can get higher interest rates in the future. And again, this might require supportive fiscal policy. So these are just some graphs. Obviously, the equilibrium real interest rate has been shifting down over time, and people have been learning about what it is. This has been reducing policy space, and it means that the interest rate cuts that we saw in many countries weren't as stimulatory as what we thought they would be. More importantly, we've been in this bad situation where we've had macroeconomic waste, where we've had economic slack. These are data from advanced economies with inflation below the target. This is bad. This is a bad outcome because you should be using macroeconomic policies to try to eliminate that slack and raise inflation. These are just more transparency indicators. You can see poor India is really low, but don't worry, the data are from 2014. We worked with India in terms of developing a framework, and they will bounce up to 10 the next time they revise these Dinsor and Eichengreen transparency indicators. So India has developed a framework, and that line is going to shift right up the next time they revise them. Okay, so let's go to the substance. So this is at the heart of inflation forecast targeting before the crisis. It was called an inflation forecast-based reaction function. And it kind of deals with the problem of things like output gap uncertainty, model uncertainty, forecast uncertainty, effectively. And the way that it does that is that the interest rate depends partly on a measure of inflation that's partly observed. So any errors that you make measuring the output gap, your model is wrong, you get the slope of the Phillips curve, all that stuff should show up in actual inflation. So as long as you feed back a little bit on actual inflation, okay, you can look forward, but as long as you feed back a little bit on actual inflation, it works marvelously. It didn't work so well in the crisis. Why didn't it work so well in the crisis? Well, because the output gaps got really big and inflation was way below the target. There we need to have a loss function. So I've switched from inflation forecast-based reaction functions, which I think were working very nicely, to a loss function. So now what we're going to do is calculate the path of the policy interest rate by minimizing this objective function, which has the squared deviations of inflation from the target and the squared output gap deviations. So what is this loss function going to do? It's going to tell you, I want to be really aggressive at cutting interest rates, and I want to keep interest rates low for long when I have a significant period of economic slack. So think of an output gap of minus 2%. It's amazing what a loss function does. Minus 2 squared is 4. If the inflation rate is 0 and the target is 2, I got another 4. So that loss function is going to say, do whatever it takes to actually ease monetary and financial conditions to basically get away from this period of high unemployment and economic slack. This cannot be picked up in a reaction function unless you have time-varying weights on things like the output gap. Okay, so in a paper by Ingen, Laubeck, and Reifschneider, they show that the experiences of the Fed in 2009, 2010, the only way that you can explain those policies with a linear reaction function is to think of that coefficient on the output gap as becoming much bigger during periods when there's lots and lots of economic slack. So what we're going to do is simply just calculate the path for the policy rate from this loss function. Okay, again, very, very intuitive. It's going to be much more aggressive than a reaction function when you have the combination of economic slack, high unemployment, and inflation below the target. So these are just some examples applied to Japan, to Australia actually. So this is an example where the output gap's minus 1.5%. So that's pretty significant. The loss function does not like that. It wants to eliminate that output gap. The inflation rate, as you can see, Australia has a range of 2 to 3%. So inflation is significantly below the 2 to 3% range. So the loss function is saying if we can cut interest rates, everything can improve. Inflation can improve because it's going to be moving towards the midpoint of the band. The output gap, you're going to be eliminating that faster. So the answer is you cut the expected path of the policy rate, okay, which is the red line in this case. You convince financial markets that you're going to keep interest rates low for long. As a result, long-term interest rates fall, the exchange rate depreciates, and that then provides the stimulus that's needed basically to close the output gap faster. So one might ask, well, if you're not a seasoned inflation forecast targeting central bank that has done this for years and years and years, since these are working partly through expectational channels, maybe fiscal might help. In other words, so this looks at a situation where we have direct demand support from fiscal policy to sort of take some of the pressure off monetary policy by keeping interest rates low for long. So that's just an example of how you can use a loss function that will incorporate these more aggressive sorts of policies. We also consider situations, and this is what central banks really care about, is not just the baseline modal forecast. So we also consider a situation that Australia should be worried about, which is what if the global economy were to turn south? Commodity prices would obviously fall. Australia is very vulnerable to what happens in the global economy. So this is just looking at what would happen if we had this loss function complemented with fiscal policy. And the answer is you cut interest rates, keep them low for long, and the reason you're doing that is you want to stimulate the economy in response to bad shocks so that you get away from the zero bound as quickly as possible. Okay, so the last point I want to make, what happens if you get caught in a low inflation trap? So this might mean more than just cutting interest rates, keeping them low for long. It might require fiscal policy. And in the case of Japan, last year, we actually recommended an incomes policy. In other words, try to coordinate price and wage setters by encouraging them to incorporate a 2% inflation premium into the wage price setting process. So, but obviously you want to avoid getting caught in one of these low inflation traps, because the longer you stay there, the more inflation is going to get stuck in that neighborhood. So on that note, I think I will end, which I think is about 3 minutes ahead of schedule.
1 minute, but thank you.
I thank the conference organizers for giving me an opportunity to discuss Dr. Laxton's papers. And before going into my comments, I'd like to briefly mention about this small footnote here. So here is our deputy director here. So, and this is my view and not BOJ's. So this paper discussed monetary policy framework and a new economic and financial environment, so-called new mediocre. And this new environment is characterized by a couple of factors, such as declining trend growth, natural rate of interest rate, low inflation environment, thus the higher risk for hitting effective lower bound. And such an environment raises monetary policy framework implications. So this paper first discussed about the effectiveness of inflation forecast targeting under normal situations. But with a higher risk for hitting effective lower bound, this paper also examines the possibility for some kind of risk avoidance strategy for monetary policy based on the loss minimization, loss functions. And also, he didn't mention about in his presentation, but this paper also take up the issues related to the financial stability considerations and how to use macroprudential policy tools, etc. And this paper is a very thought-provoking, but unfortunately, this paper is not self-contained. This is a kind of collection of Dr. Laxton's previous studies. And to understand the contents, we need to read a large number of his other papers in references. So this is my first criticism about his paper. Okay. And I have 4 major comments. First one is understanding of inflation forecast targeting, abbreviated to IFT framework. So this is something like FIT versus IFT issues Dr. Laxton mentioned. So let me start by reviewing the standard understanding of flexible inflation targeting, FIT. So a central bank makes a strong commitment to price stability in the medium to long term. Thus, then this credible commitment anchor long-term inflation expectations around the price stability target level. Then that makes a central bank possible to flexibly respond to external short-term shocks. And so flexible inflation targeting, this makes the flexible inflation targeting very effective, but at the same time, flexible inflation targeting need to include various measures to improve transparency to make monetary policy credible and effective. For example, publication of minutes or inflation reports, regular press conference after the monetary policy meeting, etc. So the flexible inflation targeting is understood as the best practice of monetary policy at the moment, I think. And so it is so-called constraint discretions. And it is not a rule, but a framework. But it is very systematic, but flexible and high accountabilities. So it is still unclear for me that there exists a difference between explicit and implicit inflation targeting. So current flexible inflation target seems to me just some kind of version of implicit inflation forecast targeting. So, okay. And so, and in talking about the choice of policy framework, I always discuss the importance of how to balance the 2 definitions of price stability in practice. My 2 definitions of price stability is something like this. First one is a measured price stability. This focuses on maintaining a specific rate of inflation measured by a specific price index at a particular point in time. The other one is a sustainable price stability. This focus is much more on consistency with a medium to long-term sustainable growth. And this pays more attention to financial and macroeconomic risk management. So the choice of the policy framework is crucially related to how to balance these measures. And in my understanding, inflation forecast targeting framework may be very helpful to improve the credibility, and so much more, the central bank needs to much more focus on the measured price stability. Inflation forecast targeting may be effective. And move on to the second one. Second one is importance of anchoring long-term inflation expectations. So this is closely related to Japan's experience. So this picture shows the core inflation rate in Japan. So from 2013, Bank of Japan has employed a so-called QQE, quantitative and qualitative easing, and expanding balance sheets significantly. But still, the inflation rate is far below the 2% target. So our basic projection will be in fiscal 2019. So the year starting from April 2019 to ending March 2020, will be very close to 2%, but still we need a couple of years to reaching the price stability target. So one of the most serious obstacles to escape from deflations or achieving an inflation target in Japan is the persistently low inflation expectations. This picture shows the long-term inflation expectations in Japan and US. So this picture shows a very contrasting movement in long-term inflation expectations in two countries. So in the United States, it's anchored around very, long-term inflation is anchored around 2% target. But still, about Japan, it declined significantly in the second half of the 1990s and remains low and far below the 2% target. So this is a very important point in discussing how to escape deflation in Japan. And this diagram shows basic thoughts behind our QQE measures. So this is a traditional Phillips curve. And of course, it is important to stimulate the economy to push up the inflation rate. But at the same time, it is important to raise long-term inflation expectations and upward and anchoring that expectation around 2% target in this case. So moving on to the third comment. I agree with about the risk avoidance strategy. I agree with the importance of risk avoidance strategies given the high possibility of hitting the effective lower bound in nominal interest rate. But I don't understand how such risk avoidance strategy incorporate unconventional monetary policy tools when hitting the effective lower bound. So maybe we need to consider some kind of shifting from standard interest policy to unconventional policy framework. So this picture shows policy rate reduction when the economy was hit by very large shocks. One first shock is the burst of tech bubble in the early 2000s. And the other one is a global financial crisis shock in 2007 to 2008. So basically, most central banks in advanced economy reduced the policy rate more than 4% or something like that. So we at the moment, most central banks do not have room for cutting interest rate, policy rate, that amount. So policy response in future need to be considered some kind of unconventional monetary policy tools, or large-scale asset purchase, or negative interest rates, etc. So maybe it is very different policy management from the conventional monetary policy. So I'd like to know how these components are included in a risk avoidance strategy. So, and in that case, unconventional monetary policy measures, it is important about thinking about policy effectiveness. So my point is the financial system rescue operations versus macroeconomic stabilization policy operations. So using unconventional monetary policy tools, so and dealing with the financial system's instabilities in the short run. So it is very effective, but we don't know how effective about the macro stabilization policy purposes. And so this is an important point to consider about the risk avoidance policy framework. And especially in my understanding, unconventional monetary policy has changed significantly after the global financial crisis, especially about the collapse of Lehman Brothers. So before that, basic policy framework, policy philosophy for monetary policy is basically try to make neutral as possible about the intervention of resource allocations, market prices, etc. But after crisis, monetary policy, especially unconventional monetary policy, intend to influence market prices or resource allocations significantly. So those things are, I don't know so how those aspects are incorporated in this framework. Okay, I'll skip fourth point, and I do a minor comment. So about the policy reaction function about the inflation forecast targeting. So it is shown something like this. some questions on specification of this reaction function. One is the inflation indicators, core versus headline, and timing of data observations. So basic definition of core inflation indicator is something like this. So the headline inflation, so core inflation indicator is some kind of a trend component of headline inflations. And the error is always IID shocks. And so based on these definitions, using how to use division of labor in about inflation indicators, target in the long run is the headline. And assessment and projection in the short term is core. So I don't understand why the core and headline is used in these framework, in these specifications. And so some papers mention that core inflation is a systematically downward biased indicator of headline inflation. This may be a failure of tracing the trend component by a core inflation measures, or some problem in measurement errors in headline inflation or something like that. And timing of data observation. So in his presentation, up to T2 to T plus 4 is a model forecast, and just T1 is partly observable. But in my understanding, inflation indicator is a lagged data, and even PIIE plus 1 is observable in a real-time basis. Also, YT, output gap, is also unobservable in a real-time basis. So this is a very small point, but I don't understand about the formulation of the inflation forecast-based policy reaction function. Thank you.
Okay, thank you very much. Now I'd like to give opportunity for our speakers to respond to the discussants.
Oh, thank you. Just very briefly, thank you, Deputy Governor Jeon, for very thoughtful comments. You mentioned that macroprudential policies have limitations, and I do agree. We can never completely stabilize output, inflation, financial markets, and macroprudential tools are relatively new, and we need more research on how to use them and think of new ways to use them. But I do find the evidence fairly convincing that to the extent that we do use them and understand them, they actually do have more measurable effects on financial stability than monetary policy, in my view. So I still stand by the idea that they're still a better tool, even if we're imperfect. Just to focus on Korea, yeah, household debt is a bit of worry, and I'm afraid I'll need to do a bit more looking into that. The new fiscal measures of the government, in particular, are something we didn't consider in the paper. We should need to update that. They should help, I think, in Korea's case, if I understand them. I would point out, though, a couple things. You mentioned that the policy rule in Korea is below where the Taylor rule or the Clarida-Gertler-Ghali rule might be, but that was, if I understood it correctly, assuming the original Taylor and CGG rules and not taking on board the possibility that the equilibrium real rate might have fallen. So I think that's something to think about. And then I have a question, which is, very recently the Bank of Korea and the government of Korea, I guess, jointly lowered the inflation target from 3 to 2. I'm a little surprised that happened. Just my understanding of talking to economists at advanced economy central banks is, well, we have targets of 2 for a very long time now. We've devoted a lot of effort into explaining them and credibility. It would be very messy and complicated to change those targets. But if we had to do it all over again, knowing what we know now, we probably wouldn't have chosen such a low number. That's my sense. We probably would have chosen 3. Some people would say 4, but perhaps not quite that low. So I guess I would think that countries that aren't in that fixed historical position where they have a huge pile of past sort of commitments and credibility built up, I wouldn't think you wouldn't want to go to such a low number. But
thank you very much for the comments. Implicit inflation targeting versus explicit inflation targeting. So Canada is a great example of an implicit inflation forecast targeter because we were doing actual monetary policy, thinking in terms of instruments and objectives. So what happened is inflation targeting was just telling people what we were doing, okay, and setting a numerical objective of 2%. To reinforce Joe's point about the 2%, in Canada, inflation is so well anchored to 2%. Like on average, people really believe in the 2%. And so, you know, raising it to 3%, we thought, you know, that's something maybe we should consider, but it's probably better to improve the framework, improve the tools, improve the transparency of monetary policy so that asset prices, you know, act as shock absorbers and we stay away from the, you know, the zero bound. But for economies where inflation has been drifting down below 2%, I really think you need to consider the 3%. Remember Ellen Greenspan's quote about what the inflation target should be? And he said, it should be a number that's low enough that it doesn't matter. And I guess I'm starting to question that now because it could be so low that people forget about inflation expectations. And I think you're seeing that in some countries. They just don't embody any positive inflation premium anymore because the inflation rates, you know, once it's 1%, you know, it's not big enough to matter. And the incomes policy, which I never talked very much about, but in 1933 in the U.S., obviously the economy was in the Great Depression, and one aspect, inflation, deflation, one aspect of this was basically an incomes policy. And actually, if you look at work by Romer, it seems to have been pretty successful at sort of getting them out of a really bad, you know, situation. So I don't know why there's not much more emphasis on what we call the comply or explain philosophy, and if that doesn't work, obviously use, you know, tax incentives to encourage people, you know, to believe that there's going to be a 2% inflation premium. Everybody's going to benefit from this because if both wage and price setting decisions reflect this, you know, we're just moving away from, you know, a vulnerable place for the economy. The interest rate reaction function, the PIIE plus 1 thing, sorry, we're thinking in terms of a quarterly model, and so PIIE plus 1 would be the, you know, the quarter that we're actually in. So PIIE, you know, would be where we have a full information set of all the macro variables, including the national accounts and so on, right? So that's how we think of PIIE. But if you didn't like that, we have other versions that have pi 4 t plus 3, if that would make you, happier.
Okay, thank you. Finally, we have now some time to receive questions from the audience. So we have about 20 minutes. So the way we will do is we'll collect a couple of questions first, and then any of you can respond to these questions. Yes, please.
I would like to learn from Mr. Gagnon and also Mr. Laxton about the experience in emerging market. Yeah, this is related to the limitation of this, the macro instruments, especially the monetary policy. If you recall, during the QE 2009-2012, there was a huge capital inflow coming into emerging market, and 90% went into only 8 countries. Yeah, and 5 of them later on became a fragile 5, including Indonesia and India. There was a problem at that time. I was in the government at that time, because if you try to use the monetary policy to do sterilization, that will be very expensive and very costly, especially when the spread between the domestic interest rate and the Fed is relatively high in the case of Indonesia and maybe India somehow. If you try to use fiscal policy by tightening fiscal policy, it's not politically easy because you tighten fiscal during the capital inflow coming into the country. If you try to use the macroprudential, you know, considering the amount of the capital inflow, it's not very effective as well. Yeah. So we voiced this issue during the G20 meeting in Moscow, how to manage this issue of capital flows. And on the reverse, when the Fed unwind the QE during the taper tantrum, the similar things happen. Yeah, the country who let the exchange rate to appreciate during the QE experienced a turbulence during the taper tantrum. So my question to both of you, perhaps you can suggest us in the emerging market what kind of policy instrument that we can use, because we as a policymaker, we are constrained by all this kind of situation. We are not living in the first best world. We are living in the second best world running by the third best bureaucracy, and that's the reality.
Other questions? Yes, lady.
I'm Chang-Shu from the BIS. My question is to Mr. Gagnon. Your work with Philip is very interesting. You have this interesting proposal of Asia undertaking the QE program. I want to get a sense from you, at what point should Asian economies undertake this operation? You talked about the UK and US being aggressive. Even in those two countries, the QE program was not started until the interest rate was approaching the zero lower bound. So are you thinking of something preemptive? And if you are considering a preemptive action, what sort of indicators would you look at? What are the factors you would consider? What are the constraints and risks involved in this pretty preemptive action? Thank you.
Okay, also a question related to EM countries. Yes, Junma, in the front.
Yeah, some of the discussions are on inflation target, whether it should be 1%, 2%, 3%. It may be relevant in some of the countries you refer to, but I see sort of a less relevance in many emerging market economies where structural issues are preventing the relevance of inflation to growth. Now, if you push inflation target from 1% to 2%, it's not very clear how much money you actually need to create, additional money. Whether you need to have another 3 percentage points for M2 growth or 5 percentage points. There's a lot of instability in this money demand function. And if in order to achieve a 1 percentage point inflation additional, you need to create a lot of money, then it leads to a lot of other problems. For example, in countries where people have a strong preference for assets, like real estate, much of the additional money goes into the real estate market. It creates a lot of asset inflation, monetary instability. And in countries where leveraging is already very high, that creates another problem of even higher leveraging. And also in countries where soft budget constraint is a major problem. These companies, which have a perceived sort of guarantee from government and so on, they borrow a lot, they borrow too much. It may create micro-level instability. I'd like to get some reactions from you.
Okay, let's have one more questions on EM related first. Yes, a gentleman at the back, I think, raised the hands first. Yes, at the very back. Yeah.
Thank you, Chairman. My question is for Mr. Laxton.
Excuse me, can you identify yourself?
I'm Hee-si Kim from the Bank of Korea.
Oh.
I'd like to talk about Australia. The policy rate cut may not necessarily have expansionary effect. The reason is that Australia's net foreign liability was more than 50% of GDP in 2008, before the crisis. At that time, Korea's gross foreign debt liability was just 15% of GDP. So this is the net. 50% of GDP is very huge. And how they finance the debt? Banks issue long-term bonds denominated in US dollars and sell it to US investors. Around 60% of their debt is denominated in foreign currency. And if the rate is lowered, then they will find it difficult to sell their bonds abroad. Then the banks will find it difficult to finance their long-term loans to mortgage market. I'd like to listen your response. Thank you.
Okay, let's stop here and then give a chance for our speakers to respond. You can address any questions you want.
Okay, I guess I'll go first in response to Minister Basri's question. I think the answer to your question really differs across countries. And I can't get into the details for every country. Many countries during the period of the supposedly large capital outflows from the US actually didn't have net capital inflows. They actually had net capital outflows. Even though they had some gross inflows, they had even bigger outflows. Now, Indonesia might not have been in that position, I'm not sure, but I don't think you had a very large net inflow because you never had a very large current account deficit. So we, on the other hand, did. We actually were the biggest net inflow country in the world. Of course, there were gross flows in both directions. I guess what I would say is the key questions I would say in that situation is your current account deficit a problem or not? I don't think it was in the Asian countries then. If it becomes a problem, maybe you could apply capital flow measures as Brazil did, where the current account deficit was more of a risk. The IMF has talked a lot about that. I actually support that. I think capital flow measures make sense in some circumstances. I think a key capital flow thing would be to try to clamp down on risky foreign currency types of capital inflows, which I think, as Mitali said yesterday, Indonesia actually has had some success in that regard and is in a better position, so I applaud that. But all of these things still don't strike me as a reason to take monetary policy's eye off the ball of macro stabilization. I really, whatever is going on that you don't like, there are always better tools, I think, than the interest rate, in my view. In terms of the other question, the woman there I didn't get, do I think we should have preemptive easing near the zero lower bound just because we're at the zero lower bound? Well, no, I wouldn't quite go that far. But what I would say is if you are near the zero lower bound and your inflation takes a hit below target, some kind of negative shock pushing you below target, and you're near the zero lower bound, that's a reason to be more aggressive, not less aggressive. But if there isn't, until there is a shock, and as long as you're at target, I wouldn't preemptively move away from the target. I would just say that if there's a shock pushing you below target and you're near the zero lower bound, then you need a more aggressive response. And then finally to Jun Ma's question, that's a tough one. I think you had a presumption that a stimulative monetary policy trying to get inflation back up to target is going to show up in asset prices first before overall inflation. I think I'm not sure that's a general result. Maybe it happens in some circumstances and sometimes and not others. It's a case. It's a situation each country is going to have to think about when it happens. To me, the answer is still, if you aren't unhappy with the asset price behavior, I would think macro-prudent measures exist that are going to be more powerful than any monetary measure. I mean, think about if you think house prices are going to rise 10% a year, a 1 or even a 200 basis point rise in monetary policy isn't going to deter you very much, but it might kill the economy. So it seems like a very blunt and bad tool to use in that circumstance. I just can't, if you raise the policy rate 10%, maybe it would have an effect, but then you'd have a massive depression. I don't think it's worth it.
Remarks that Joe said. Back to the transmission mechanism in Australia. So I think you've given legitimate reasons for why it could be blunter. But I don't think people at the RBA are really concerned that the interest rate channel isn't isn't working, right? I mean, it still affects, you know, interest rates on mortgages and consumer credit and investment. So I think you have to look at, you know, the total effects, and not just the ones that you mentioned, but there are legitimate reasons why it could be blunter. On the issue of raising the inflation target, that this somehow could increase money, is that my understanding, that you're concerned that if you raise the inflation target from 2 to 3, that could result in big expansion in money? Well, I guess it would probably be about 1 percentage point, and since everything's changing, all nominal variables are changing, then, you know, nothing real is going to happen in the long run. So that would be my response.
Okay, there was also another question from the BOK person, whose question I sort of interpreted as meaning, if there is a spillover, a positive spillover from the US or the other advanced economies, obviously there is a corresponding outflows, but that inflow and outflow is not cost neutral. And if you reduce your interest rate, the amount of inflows and outflows might increase, raising the non-neutral cost to that recipient country. Do you have any responses to this?
I think, wasn't that Minister Basri's question, I think?
No. He also talked about capital inflows, but he was talking more on the capital control measures, whereas the other gentleman from the BOK was talking more generally on the non-neutrality of cost of inflows and outflows. Of course, the net will be determined by the current account, but...
Yeah, I'm not sure, maybe I didn't, I'm not sure I really got the question very well. Perhaps you could, what is the nature of the cost that you're thinking of?
Well, I think he was referring to potentially the investment that is actually taking place, or the purchases of financial assets that inflows may actually account for, and the type of return that you get on the outflows. And that's non-neutral, if I'm correct.
Not sure I understand. I still don't think I know what. I don't know what I have to say about that. Doug?
Okay, you need to take that into consideration. Okay, do we have more questions? Yes, there was a gentleman there in the middle.
May I ask the prominent speakers how the different stance of monetary policies in US and UK versus the EU, ECB and Bank of Japan affected the evolution of sacrifice ratios after global financial crisis? Has there been any influence of different monetary policy stance on the change in sacrifice ratios in these advanced economies, or was it irrelevant? And my second question is, in the monetary policy in the new media area, the publication of the future path of policy rate, would it be effective in inflation forecast targeting or not? Thank you.
Hello. So we're getting into technical talk when we talk about things like the sacrifice ratio, right? So the sacrifice ratio we typically define as what's the cumulative output loss to reduce inflation by 1 percentage point, okay? And I think the way that you're thinking about it is the slope of the Phillips curve, like the sensitivity of inflation to output. Is that correct? When you talked about the sacrifice, because we're not talking about moving the economy from one inflation rate to another inflation rate. So I would probably not use that term sacrifice ratio because it's more about things like the costs of disinflation and that sort of thing. But it comes back to what Joe was talking about, non-linearities and so on. So during that period of economic slack, the slope of the Phillips curve was like really, really, really flat. That's sort of consistent with a convex view of the Phillips curve, which is what we've had in our models for years and years and years. So the actual, this period has been very, very good for us because they've made our models work really, really well because we work with these Phillips curves that are super flat. In other words, once you get so much slack, you know, there's very, very little disinflationary pressure and so on. And so obviously, central banks like the US and the Bank of England that were more aggressive at, you know, eliminating the slack, you know, that obviously is going to have more expansionary effects in those economies than the ones that were a little bit slower to eliminate the slack. Did that answer your question? Or I was a little confused about the sacrifice ratio.
Okay, maybe one last question from the audience. Yes.
So I had a more general question about deflation and perhaps addressed to any of the speakers or discussants, and perhaps a naive question. You know, so the specter of deflation has been haunting central bankers, particularly in the advanced economies, to the extent that the push for high growth is coming from the fear of deflation. So I looked into this a little bit, into the Japanese case while I was at the RBI, and I thought I would quickly, describe 4 findings, and I would love to hear, whether these make sense. So the first finding was that, once Japan cleaned up its banking system in the 1990s and early 2000s, the Japanese growth in real per capita income growth was actually comparable to some of the advanced economies. So it could be that, the slow aggregate growth could be due to population and labor force shrinking than, underperformance of Japan vis-a-vis other advanced economies. Second, one of the fears is that, deflation is associated with higher real wages and, unemployment. I looked at, 2000 to 2014. On average, unemployment rate was 4.5% in Japan compared to like 9.4% in Europe and 6.4% in the United States. Third, the fear is that, moderately low inflation can, spiral towards deflation. If you look at the period, I looked at the period 99 to 2012 or so, CPI inflation in Japan was about like range between 0 to 1.3%. I did not see, the spiraling, kind of an effect. And the fourth and the last point is that, one of the worries about deflation is that, there's postponement of purchases in anticipation of lower prices. So, deflation is associated with higher savings. Again, I looked at the Japanese data and I did not find much evidence for that. So I would love to hear, the speakers or the discussant views on the topic.
Yeah, sure. I'll take that one if you don't. So a couple things. I think people said this yesterday. I know Adam did, and I think others too, that Japanese growth actually doesn't look that bad, really, when you control for population. And so I really am trying to avoid saying that, low inflation is causing slow Japanese growth, because I don't think that's really where it's at. What I do think is true is that the level of output in Japan has been below potential, albeit growing at the potential rate, but constantly below where it could have been. So it's not a growth rate story, it's a level story that I would argue. And when you said, well, but the unemployment was only 4.5% in Japan versus 9% in Europe and 7% in the US or whatever, well, historically, 4.5% unemployment in Japan is inconceivably high. They never had such high unemployment in decades. We have to think of unemployment rates as being different across country for structural reasons having to do with the benefit system and social policies. And the natural rate in Japan is much lower than 4.5%. So that's actually a very bad outcome, in my view. But you're absolutely right that we didn't get spiraling deflation, which some people worried about. And I attribute that entirely to the downward wage and price rigidity, which we focused on.
Okay, any final words from any of our speakers or discussants?
So I agree entirely. It's like you want to think of it as a level effect, but in addition, there's excessive variability, okay? So I'll give you a good example. So right after the global financial crisis, you compare Canada, an inflation forecast targeting central bank that's been doing it for a long time, and you compare it with Japan, okay? So what actually happened? So Canada exports, well, 80% of their exports go to the US. US was the epicenter of the crisis. Canada is also a commodity exporter. So when we went into the crisis, Canada should have been really affected, right? Because its export markets fell and commodity prices crashed, okay? It was a massive shock for Canada. What actually happened? Well, they had 400 basis points of interest rate space, so long-term interest rates fell a lot, and the Canadian dollar depreciated quite significantly. And those two things acted as important shock absorbers for the Canadian economy, just like they do every day. In Japan, unfortunately, what happened? They only had 50 basis points of interest rate space, okay? The value of the yen appreciated substantially. Exports fell by twice as much as in Canada. And not only did exports fall, but domestic demand fell for the very same reason that the monetary transmission mechanism helps. It can also hurt, because if the real interest rate rises, it appreciates the real exchange rate and compresses domestic demand and so on. So it's not just a question of, you know, the level. You get excessive variability in economies that are close to the effective lower bound, and you don't have other policies basically stepping in to, you know, to offset the space that's lost.
Thank you, Douglas. Any other last words from our two discussants? No? Okay, then, well, I think I've learned a lot, certainly, a long list, but there are still a couple of questions that remains. In one particular, nobody will doubt or challenge the fact that inflation is a monetary phenomenon, but in the long run. So the question is, how long is long? So the second question that I have is, certainly greater transparency will help shape expectations, but that also is certainly true in the short run, but it can actually hit back in the medium long term if your performance is not delivering. So what do you do? These are still, I think, the remaining questions that we have to answer. But anyway, thank you very much for your attention, and thank you very much for your contributions here.